All right, well, we want to bring our guest right here on the close. His name is Tim Hayes. He is the Chief Investment Strategist at Ned Davis Research. He joins us from the offices down in Sarasota, Florida, where it's probably a lot nicer and warmer than it is here in New York, where suddenly the weather has gotten nasty. Tim, thanks for joining us. I read your report. You yesterday upped your stocks allocation by about 10% to 65%. How much of that was due to Europe as opposed to the picture here at home?
Well, it's really more of a response to the global market action, which includes the U.S. and Europe and China and sectors around the world. It's been very broad-based. In fact, we had the highest percentage of stocks make 30-day new highs than we had seen on record back to 1980. We'd also had some very impressive numbers on the percentage of stocks and markets rising above their 50-day moving averages, and several markets are getting close to rising above their 200-day moving averages. So what we've seen is a breakout from this bottoming process that started back in early August, and that's the reason our indicators picked that up. We got some important signals 2 days ago, actually coming into yesterday, which moved us to make this upgrade.
Now, I got to ask you, as I'm sure everyone would, it would have been nicer if the signals had been tripped when the market was 10% lower. What took so long for these signals to kick in?
Well, we're in an unprecedented period of market, just the gyrations in the market, the degree of correlation in the market has been something we haven't seen in recent memory. In fact, we have not only correlations between stocks and the markets, but between asset classes. And this has made the down moves much more extreme than normal and the up moves much more extreme than normal. In fact, if we go back to August, we'll remember that we had those initial big down moves, and then we had the recovery rallies. We would turn around and have a similar percent down right after that. So it's been you have to kind of tread very carefully in this environment. We wanted to see our longer-term indicators confirm that this isn't just a continuation of this very choppy, volatile period, but in fact, we're moving out of a downtrend and back into an uptrend, and it's taken us that much time to have that confirmed.
Now, you, Tim, you write articles in the Journal of Technical Analysis. You're quoted frequently in the Wall Street Journal. So let me ask you, if you're going to put out an article, say, in the next week or two, what's your target for the S&P 500 from here with all this new money you're putting to work?
Well, we really don't like to use targets. We really like to use a weight of the evidence. We like to look at our indicators and tell us how broad-based is the move, how many stocks and markets and sectors are taking part, how many stocks are making new highs. But I will say that we've looked at a test of this year's high in the 1350-14 area as a likely reward zone. And if this is in fact, which I think there's a good chance of it being, a cyclical bull market within this ongoing secular bear market that started back in 2000, then a 60% rise is reasonable. And I would think that that would take us back to a test of the 2007 highs within this long sideways trending market that we've had over more than 10 years.
So let me ask you, what's on your shopping list?
Shopping list? I would go with the beneficiaries of this risk-on trade, which has really come back with vengeance here. In fact, we have something called the risk-on, risk-off ratio, or the ROE ratio for short. And what it does is it shows that the risk-on areas, which include the sectors like materials and energy, so commodity-based sectors, commodities themselves, such as oil, the copper-gold ratio, they tend to do very well when you get into this risk-on period. And then when you're risk-off, it's more the defensive areas. You get bonds doing well, the dollar rallying. And so I think that trade is still, the correlations, in fact, yesterday reached new extremes, which I thought was really a sign that this is really what it's all about. And this really explains why we're seeing such high correlations. And a lot of it has to do with this ongoing or under the surface concern about economic growth. That relates, of course, to the problems in Europe. And in fact, I'd also point out one of the more encouraging developments has been China, which has actually been the strongest market since the recovery began back on October 3rd. Also, we've seen the bank stocks doing very well. Even the European bank sector is up 23% from the low, which is an encouraging sign. So that's where I'd be focusing right now.
All right. Thanks so much, Tim, for joining us. Got to leave it there.